If trading is so popular, and if the tools to do it are now available on every smartphone in the world, why do most traders lose money? Not just a few, not even half. Most. Statistics from brokerage firms consistently show that between 80% and 95% of day traders fail to turn a profit over the long run. That sounds extreme, perhaps even discouraging. But it is a mathematical reality. The common explanation is that people are just careless, impatient, or too emotional. And while those things definitely matter, they aren't the primary reason. The real reason is much deeper. It is structural. When you enter a trade, you aren't just interacting with a neutral chart or a fluctuating number. You are stepping into a high-stakes ecosystem where every time you make a decision, someone else is standing on the exact opposite side of that decision. That one fact changes the entire nature of the game. It turns a hobby into a sophisticated battle for capital. Let's strip away the complex terminology and simplify what trading actually is. When you buy a stock, an option, or a currency pair, someone else is selling it to you at that exact price. When you decide to sell, someone else is the buyer. Every single trade has two sides. In the short term, this means trading is essentially a zero-sum game. This is fundamentally different from a traditional business or long-term investing. In a normal business, value is created over time. A company builds a product, sells it, and everyone involved can theoretically win as the company grows. But in the fast-paced world of trading, money doesn't just appear out of nowhere. It is transferred. For you to book a $1,000 profit, someone else, or a group of people, had to be wrong to the tune of $1,000. Money moves from one participant's pocket to another's. So the most important question you can ask before clicking buy is, who is on the other side of my trade? Because in this environment, their gain is your loss. When most beginners start, they imagine they're just reading the market, like they're solving a puzzle in a book. But the reality is much more intense. You are competing against the most sophisticated minds and machines on the planet. On the other side of your screen are professional traders, people who have spent 20 years doing nothing but studying price action, hedge funds, organizations with billions of dollars and rooms full of PhD mathematicians, high-frequency algorithms, computers located physically close to the exchange servers that can execute thousands of trades in the time it takes you to blink. These participants have asymmetric advantages. They have better data feeds that cost thousands of dollars a month. They have faster execution speeds. They have massive capital reserves that allow them to stay in trades longer. An algorithm doesn't get a gut feeling, doesn't hesitate because it had a bad morning. It reacts to market changes in milliseconds based on cold, hard logic. When a beginner enters this arena without a tested mechanical system, they aren't just at a disadvantage. They are the liquidity that the professionals use to get paid. It's not an equal playing field. So why do so many people stand in line to join a game where the odds are so stacked against them? It's because of the illusion of easy money. Trading looks deceptively simple from the outside. You see a green candle move up on a chart and think, if I had just bought there, I'd be rich. Social media is flooded with people posting massive P&L screenshots and quick wins. This creates a distorted reality where money seems like it's just sitting there, waiting to be grabbed by anyone with a laptop. But what you don't see in the highlight reel is the structural wreckage. The 5 losing trades that came before that one win. The months of psychological exhaustion and inconsistency. The drawdown periods, where an account loses 30% of its value in a week. Winning trades are loud and visible. Losing trades are silent and hidden. This survivorship bias tricks beginners into walking into the market expecting a paycheck when they should be preparing for a war of attrition. This is the mechanical heart of why traders fail. They do not have an edge. In the world of probability, an edge is a small, repeatable advantage that plays out over a large sample size. Think of a casino. On any single spin of the roulette wheel, the casino might lose money. But because of the green zero, they have a tiny mathematical edge. Over 10,000 spins, the house is guaranteed to win. Most traders are gambling, not trading, because they don't have a repeatable advantage. They trade based on a tip they saw on Twitter, a feeling that the price has gone down too much, a single indicator they don't fully understand. Without a mechanical edge, trading becomes a random walk. And when your results are random, the friction of the market, trading fees, commissions, and small execution errors slowly grinds your account down to zero. It's like flipping a coin where you lose $1.10 on tails but only win $1 on heads. Eventually, the math catches up to you. Another structural trap is the mathematics of loss, which is inherently unforgiving. In trading, gains and losses are not symmetrical. If you have a $10,000 account and you lose 10%, $1,000, you have $9,000 left. To get back to $10,000, you don't just need a 10% gain. You need an 11.1% gain on your remaining money. If you lose 50% of your account, the math becomes devastating. You don't need a 50% gain to recover. You need a 100% gain just to get back to zero. Beginners often ignore this math. They hold on to losing trades, hoping they will come back, because they can't admit they were wrong. Meanwhile, they close their winning trades early because they are afraid the profit will disappear. This creates a negative expectancy, where your losses are huge and your wins are tiny. That combination is a slow-motion wrecking ball for your capital. Now take that unforgiving math and add human emotion on top of it. Trading triggers the same parts of the brain as survival and physical danger. After a significant loss, the brain enters a state of fight or flight. This leads to revenge trading, trying to win back the money immediately by taking a bigger, riskier trade. This is almost always when the biggest account blowouts happen. On the flip side, after a few wins, a trader often falls into overconfidence. They stop following their rules. They think they've cracked the code. They increase their position size right before a standard market correction, wiping out weeks of work in a single afternoon. This creates a destructive cycle. Loss leads to frustration and revenge trading. Win leads to overconfidence and reckless risk. Consistency is the only thing that matters in trading. But our biology is programmed to be inconsistent when money is on the line. So, when you pull back and look at the whole machine, the reason most traders lose is clear. It's a combination of forces designed to extract money from the unprepared. Unequal competition. You are playing against professionals with better tools. No edge. Trading without a mathematical probability of success. The illusion of easy money. Expecting a paycheck instead of a profession. The math of loss. Realizing too late that losses are harder to fix than they are to make. Emotional pressure. Our brains aren't naturally wired for the stress of risk. Most participants struggle not because they aren't smart, but because they underestimate what trading actually requires. It isn't just clicking buttons. It is a high-performance skill, similar to being a professional athlete or surgeon. It requires a rigid structure, iron discipline, and a massive amount of time to master. So, why do most traders lose money? It's not because trading is rigged or impossible. It's because it is misunderstood. People enter the market expecting a shortcut to wealth, and they find themselves in a system that only rewards those who have a structured, dispassionate approach to risk. Once you understand that trading is a game of math and psychology, not luck and feel, you stop looking for easy money. You start seeing the market for what it really is: a highly competitive environment where only the consistent survive. If you want to keep understanding the deep mechanics of how markets, money, and these hidden systems actually work, simply, clearly, and structurally, subscribe. Let's keep fixing the mechanics together.